Hi, I'm Margaret Giles from Morningstar. Every January, Morningstar Director of Personal Finance and Retirement Planning, Christine Benz, takes a look at capital markets assumptions prepared by major investment firms. She's here to discuss whether and why investors should pay attention to these forecasts, as well as some of the key takeaways from the 2026 roundup. Christine, thanks for being here.
Margaret, great to see you.
So many investors take market forecasts with a grain of salt, perhaps as well they should.
Right.
Why do you think that these 10-year forecasts are different and potentially useful when it comes to financial planning?
Right. I'm fully on board with investors dismissing those very short-term forecasts, like what will the market do in 2026? Who knows? But the reason I like these long-term forecasts, which are often called capital markets assumptions when various asset managers put them out, is that you have to plug in something into your plan. So you're looking to determine how much help you are expecting to get from the market. If you are someone with a very long time horizon, if you're in your 20s and 30s, I think you could reasonably use the market's historical long-term returns, something in the neighborhood of anywhere between 8 and 11%. But if you have a shorter spending horizon, maybe you're about to embark on retirement, or you're saving for some shorter term goal, like your 12-year-old is going to be heading off to college in the next 6 years, it's important to you to think about what the various asset classes might return over that shorter time horizon. And I would adjust those historical markets assumptions accordingly. So if the forecasts are especially sober, if we're calling for really poor returns over the next decade, you'd want to shrink the return expectations. If things are looking really good and stocks look especially cheap, or bonds look especially return robust, you would want to factor in higher returns. So I think it's important for those shorter horizons.
Right. So one thing that you note in your article about these forecasts is that the U.S. equity return assumptions are pretty muted for over the next decade.
Mm-hmm.
So how muted, and what are the implications for investors' plans and portfolios?
Yeah, when I look at them, they generally clustered between, say, 4% at the low end and 7% at the high end across providers. So no one's calling for, at least over the next decade, anything like the 15% return we've had from U.S. stocks over the past decade. So a couple of takeaways for me. One is that inflation is an important component of this. So those are nominal numbers, that 4 to 7% that I referenced. If inflation is going to come up and take, say, 2.5 percentage points of that return, you want to make sure that you are thinking about inflation as a component of whatever you're planning you're doing. And then you would also want to think about diversifying across equities. So one of the reasons why the return forecasts are so muted for U.S. stocks is simply because that large cap growth square of the U.S. market has had such phenomenal results. And it means that we would really want to temper our expectations for the whole U.S. market. If you have U.S. market exposure in your portfolio, to me, that suggests you want to look beyond U.S. large growth. You probably want to have some holdings there, but you also want to be looking to value, smaller cap stocks, non-U.S. stocks as well. You don't want to be sticking with just a total U.S. market index, because you are pretty concentrated in those large cap U.S. growth stocks.
Right. So a consistent theme that you've seen since you've started doing these roundups is that non-U.S. stocks actually look more attractive than their U.S. counterparts over that 10-year horizon. So is that still the case given the run-up that we've seen over the past year?
It very much is. So I will caveat that and say that most of the forecasts that I used when I did this compilation came from like September 30th, 2025. So it didn't incorporate the full year's worth of performance from non-U.S. stocks. But the return assumptions for non-U.S. stocks were, again, meaningfully higher than was the case for U.S. stocks. And that's true for both developed and emerging markets. And it was across the board. Every single firm in my roundup was calling for higher returns from non-U.S. stocks. So I think that's a consistent finding. And I think people should take it to heart as they think about doing their portfolios positioning and revisiting their portfolios allocations.
Right. So how should investors be thinking about incorporating that finding into their plans?
I think you want to look at your portfolios equity allocation, and within it, look at your allocations to U.S. and non-U.S. stocks. And here, the total market capitalization, the total global market capitalization, I think is a nice benchmark for you, where when you look at it today, it's roughly 2/3 U.S., 1/3 non-U.S. Most U.S. investors do not have 1/3 of their portfolios in non-U.S. stocks. I think this is particularly important for the young accumulators who are looking at how their portfolio is allocated internationally. To me, emphasizing or at least getting in line with the global market caps weighting of non-U.S. stocks seems like a really good benchmark. You also want to look at the emerging relative to developed markets exposure. When we look at the global market cap today, it's roughly 90-10. So I think that's a good benchmark for investors as well.
All right. So to wrap up here, when I read your article, I can't help but notice that there's a greater difference in opinion in those equity forecasts than there are for bonds. So why is that? And what are the implications for portfolio positioning?
You're totally right, Margaret, that you see a lot of uniformity when you look across the fixed income assumptions. And the reason is that starting fixed income yields are quite a good predictor of fixed income returns for the subsequent decade. And so most firms are looking at yields on 10-year treasuries today, or whatever sub-asset class of fixed income they're looking at to do their forecasts. And they're all kind of anchoring on the same thing, that they know that that's a very good number in terms of their forward-looking forecasts. So people should take that to heart. One thing that jumped out at me in this roundup was that for a couple of the asset managers, including Vanguard, as well as research affiliates, the high quality U.S. fixed income return expectations were actually higher than their U.S. equity return assumptions. And so to me, that suggests that there's not too great an opportunity cost for de-risking that portfolio today, especially if you're an older adult who is in drawdown mode, so you're actively decumulating from that portfolio. Tipping a little bit more into fixed income, high quality fixed income, to me looks like a pretty good trade to make, because you are setting aside a portion of your portfolio that you could spend from if equities encountered some kind of extended downdraft. So to me, that is a key takeaway, that balance is a really good practice for older adults. Anyone 50 and above should be thinking of tipping more of their portfolio into fixed income assets, and also adding some inflation insulation to that portion of the portfolio as well, because inflation will tend to eat into the fixed income returns over time. So balance, I think, should be your watchword if you're an older adult.
All right. Christine, thanks for giving context and perspective on these forecasts, and thanks for taking the time.
Thanks so much, Margaret.
I'm Margaret Giles with Morningstar. Thanks for watching.